This is episode 5 of the Investors Podcast.
Broadcasting from Bel Air, Maryland, this is the Investors Podcast. They'll teach you online business better than your multiplication tables. They'll give you step-by-step guides for every kind of business you desire. They'll give you actionable investing strategies. Your host, Preston Pish and Stig Broderson.
Hey, how's everybody doing? This is Preston Pish, and I'm accompanied by my co-host, Stig Broderson. And today we have another special guest with us. Today it is Gregg Pisani. And Gregg has some time working on the New York Stock Exchange. And today's interview with Gregg, we're going to be talking about what it's like to be on the floor of the New York Stock Exchange and kind of all the things that happen to a trader. So let's go ahead and just start this off. Gregg, go ahead and tell us something about yourself and just kind of give us a little bit of background.
Sure. Good morning, everybody. So my work on the New York Stock Exchange and for the specialist firms that trade the stock was actually my second full-time career after college. I worked in the film business for a while in New York City, worked on some TV shows, worked on movies with Kiefer Sutherland, Michael J. Fox, some older actors, Jason Robards, Swoosie Kurtz. I did that for about 5 years, and then the work in New York kind of dried up. There was a little bit of a conflict between the New York and Los Angeles unions that basically work on all the different films. So it was a little tough to get work, and a friend of mine said, hey, maybe you want to work on Wall Street. And I was like, all right, well, sounds interesting. Right? I came from one interesting, diverse career where you saw a lot of different things on a day-to-day basis, and so I gave it a shot.
So you didn't go there initially to do that. You went there to do the movie business and just kind of fell into the stuff.
I was always into making movies. My minor in college was film and still photography. So always had a love of movies, right? And so I did that for about 5 years, and my friend and my brother kept on with that for a while, and I didn't see a lot of future in it for myself. So wasn't like dedicated to camera work or something else. So when the Wall Street opportunity came up, I kind of took it. So my first job was working as basically an assistant to $2 brokers, right? And the $2 brokers are the brokers that are kind of independent from the big firms like Merrill Lynch. And they would basically take work from those bigger brokerage houses, and they would go work the pit, because there's never enough brokers on the floor to represent Merrill Lynch or Goldman Sachs or what have you. So they would farm out the work. It was almost like contractors in our current career.
Yeah.
So you would use them to go do the work, and they would work the different specialist booths, and literally they were booths where different firms would hold the stocks and trade them, right? So I was a clerk for this firm.
What does the $2 broker thing mean? I don't follow.
Well, I think it's more of a euphemism than it is anything, right? So I think at one time it meant that they got $2 per trade that they did when the firm first started, right? Somebody told me that. I don't know if it's urban myth or whatnot, but for the most part, they were contracted out, officially, unofficially, to do additional trading for the bigger firms above and beyond what their capacity was to do it, right?
Did they do that model so that they could flex their size? So like if they needed, like in high volume times, maybe for a certain year, the volume would be very high so that they could kind of flex and get rid of that extra fat after.
I'd like to say yes, but I don't think it was as strategic, to be very honest with you.
Okay.
You think of Wall Street as being this well-oiled machine, and as we go on in the discussion here, it was pretty chaotic for the most part.
Yeah.
I think some of that was yes, and some of that they were not as rigorous in how they did things. So, it was probably a little give and take. All
right, so keep going, because I don't want to.
Yeah, no,
I don't want my questions to hold you up.
No, it's fine. So I did that for a short amount of time, and then I don't really know how, but the biggest specialist firm on the floor, the firms that actually control the trading of the stocks, was Spear, Leeds and Kellogg, and they were hiring. So I really wasn't digging the $2 broker job. There wasn't a lot going on. You were just basically answering phones, taking orders, and passing them off to the brokers. So I went into Spear Leeds for an interview. Basically, it was what have you done? I hadn't done much, and a math test. So, I really didn't do well in math in school academically, but when it came to monetizing math, right, the way we probably should be taught, I really got it. So the test that they gave us was dollars and cents, and everything trades in fractions, at least on the New York, right? It's more decimal points on the Nasdaq. So I did well, and I could communicate, and so I started off as a specialist clerk, and then moved my way up the ranks. So that's how I got into the specialist firm. And Spear Leads was big. They had a big operation. Things changed over the years, up until today, and I believe Goldman bought them at this point. But there's a lot of opportunities, a lot of stocks, right? Everything from small companies you never heard of to IBM. And so, spent 8 years there, 4 years on the New York, and then their American operation. And the American mostly traded options at the time, but there was stocks being traded there as well. It wasn't as automated as the New York, so they were looking to expand their operation there. And so I went over there. There was a small specialist operation there. Like I said, it was probably, 60, 75% options and some stocks, lesser value stocks that didn't make it to the New York. So it was more opportunity for growth there. So that's why
I find that really interesting about the options being 75% of the, wow.
Yeah. Yeah.
Okay, so Greg, let me actually ask you, because I'm really delighted that you're on this show. I used to be a commodities trader myself, so it's really interesting to talk to a guy like you. And as you probably know, this is really a world that a few people get to experience firsthand.
Sure.
But there's a lot of myth about working on Wall Street. I don't know if that's because there are so many money involved. But Greg, how do you would you like to tell us about a typical day? I mean, how is it a typical day on Wall Street?
So I think that the day it's kind of interesting. You make your way down to downtown, right? Whether it was the New York or the American, doesn't really matter. Everybody gets their little breakfast, right? Mine was coffee and a muffin. You get to the booth, right? You're standing all day, right? You're not sitting at a desk. And these were literally booths. The ones on the New York were circular or oval, and you're behind the counter. The ones on the American were like a long counter style, almost like a delicatessen.
How big's the room? Is the room like about the size of a football field or something?
So, it looks bigger than it is, but I believe the New York's main room is pretty large. It's probably half the size of a football field.
Okay.
But it actually is multiple rooms, and I'm presuming because over the years it expanded because more stocks came in, right?
Yeah.
So they basically had to build more rooms out, and the American is not like that. The American was one huge space with some smaller areas that were non-trading areas, and a big building. Above that's all offices, right? And a lot of them are the SEC offices. Firms have offices, so but it's each place is a little different. So you'd come in, and the day before you basically reconciled the accounting for the stocks that the firm bought, right? Because you also buy and sell for your firm because you have to make money, right? And the only way you do that is buying and selling the stock for which you trade. And most of the, let's call it,
regardless of the price, it's just the transaction.
Exactly.
Yeah.
Exactly. So, there's stations, right? And each station has, in my day, they had very simple, almost look like the old Apple Macintosh computer screens, black background with green text for the price range for the stocks.
Dinosaurs outside and all that kind of stuff.
Yeah. And then we had regular computers behind us, and they basically were anything we'd want to look at, like Bloomberg's or whatever was going on as far as news feeds.
Uh-huh.
Right. At the time when I changed over from New York to American was still on paper. So you got both electronic orders and paper orders spitting out of this. I don't even remember what the name of the machine was that spit out the orders, but it had a name. And the New York was fully automated, right?
Okay.
With more modern technology because money was really there, right?
Yeah.
So you'd get in, you had paper books that had carbon copies below them, and two sheets, the main sheet and the carbon copy, because that was your record. And basically the top sheet you tore each day or during the day, you sent up to basically the trading floor for the specialist firm, where they would reconcile the trades that you made on behalf of the company. And so you'd get ready. You'd start looking at the screens, see where the stock closed. Orders were able to come in, right? So if it closed at, let's say, round number $10, you'd get orders coming in at 9 7/8, 9 5/8, 9.5, because it's all traded in eighths. And then you'd get in orders coming in at 10 1/8, 10 1/4, up and down the range. And then you'd have stuff meet in the middle, and that's where you would most likely open the stock when the bell rang, right at 9:30. So it's all preparation. So you kind of see what's going on, and if there's news, it will impact what's going on as well. But each of the stations, had a broker, and some had a clerk as well. And you could have anywhere from one stock, which would mean that it's something busy. Like IBM on the New York was one stock traded with one broker and one clerk. So it was so busy when I was there.
That they weren't handling. Yeah, they weren't handling multiples. They were just handling that one pick.
Impossible.
Wow.
But then you'd have, someone who had three stocks. Maybe they had an AIG and a couple of smaller firms. Or someone else had Boeing, because that was one of the stocks they had as well, Spear Leads. Or on the American, I think at one point we had up to 10 stocks at a station. So, you're not talking about high volume or high dollar. It could be, something that's trading at $1, $2, $3.
So, Greg,
you could have a few more.
You said early on that so you're looking at the buy and sell orders, and then you as the manager of that was kind of picking at where that was going to open up based on where things were.
Yeah. So and it's all based on your position too, right? So that's where some of the stuff we'll get into as you move along in the questions, that while we think that everything is fluid and it's based on the economy and news and stuff, the specialist broker has a lot of control. It's almost like, wrangling cattle. You can let them run free and roam, or you could actually pen them up in certain areas and control them. So, and it's based on your position, especially if you bought a ton of stock the day before or the few days before, and all of a sudden you see there's bad news, a lot of sell orders coming in, whatever, that's going to push it down. And then you're going to be like, oh man, I'm holding 50,000 shares of this or whatever. What am I going to do here? So you could open the stock up. You couldn't buy stock on a straight uptick or plus, right? Because, you had to let other folks generate the initial uptick. Then you could buy, right? And the same thing on a downtick, right? On a minus, you can't sell on the first minus tick down because they're just policies and guidelines that control it for the specialist firm. You have to have someone else. Now, you could be part of a buy or sell, but you cannot initiate it. Like if I know the stock's going to go up, I can't buy everything at the next, if there's...
Yeah.
You guys understand.
Yeah, that makes sense.
Yeah. So how long were you typically holding on to the stocks? I mean, it sounds like it was hardcore trading, so it was clearly not one of those Warren Buffett hold for 10 years kind of thing you were doing.
Not at all. So this is probably the most, it's like investors on ADHD or whatever. They're just, right. The floor is not, not like personal investing. That's why I say it is a microcosm, and you don't really understand it until you work there, that markets are changed and shifted, especially in small firms. There was a lot more flexibility because the level of scrutiny. On an IBM, you could not do that, right?
Yeah, because of the volume of trade.
Probably.
Yeah.
I forgot what they used to call the guys on the floor that used to work for the firm, work for this the exchange that would monitor that, right? There's a whole bunch of, and the bigger the stock, the more volatile the stock, the more important the stock, the more scrutiny you got in terms of what you can and can't do.
Yeah. So, Greg, just listen to this. There was a lot of stress going around. So, how would you deal with that stress on a day-to-day basis? Is it as stressful as it sounds, or is it not as bad as it sounds, or what?
It's basically, I would say for the most part, it's not the stocks, the trading, it's not the any of that sort of thing, the mechanics of it. It's the people, right? So it's the other brokers, it's the job you have to do for the firm you work for. When things get busy, people act stupid, you know. So for the most part, I handled it well. I can say the one time that the stress level got pretty high had nothing to really do. It was a busy stock. I think it was Cheyenne, which was a software company. It could do a couple $1 million of shares in a day. That was on the American. One time I remember everyone getting kind of crazy, and another broker who worked for the firm coming over an older guy was trying to get in my stuff, right? And then there was a huge crowd out in front of me, and I basically stopped trading and told everyone to shut the F
You
up.
did?
Yeah, so I mean, do that
Yeah.
today in an office environment in ours? Probably not. But yeah, no one really thought anything of it other than they shut up, and because they were basically impacting my ability to trade, right?
Yeah.
So not only
So
for
true.
the firm, but for their orders. Orders are coming in, they're throwing them down. The paper orders were the worst thing to have to deal with because they were handwritten, and you had to figure out, I have 100,000 shares at a certain price.
Wrong
So that was
comma.
probably the most stressful day. I still recall. Other than that, I don't really recall anything. If it was bad enough, we'd probably go out for a drink afterwards and kind of forget about it. Because what trading day ends. There's no
Yeah.
homework, right?
Yeah.
Oh yeah, yeah. Well, let me ask Greg. Well, I think you lasted longer in the game than I did. I was 28 when I quit, and
Yeah.
and to be honest, I was not one of the. Clearly, I wasn't one of the old guys, but I wasn't one of the young guns either. Even though I
Right.
was only 28, because trading is really a young
Sure.
man's game. But what was your experience? I mean, how many years did you experience your coworkers to hang in there?
Well, people have different reasons for staying there. You got guys who would want to work their way up the chain and either were favorites, they weren't favorites. There's a lot of that going on. I mean, it's about as old boy network as you get, right? So, but on the other side, so I had friends on the New York Stock Exchange before I ever got there. So when I came in, there was a bunch of young folks came in as clerks and then moved up through the ranks, and the older guys were still there for the firm, and they stayed there for the firm. They were there. They were long timers, right? So, and I don't know how long, but I do know personally a family friend that I grew up with from, gosh, what age? I don't know, Jim Henderson, who owned Henderson Brothers, which was probably the biggest small firm on the New York. His sons were all there, and he was a very well respected man. That guy spent, I'm guessing, his entire life there, and still there, and still has friends that work for. They were absorbed by another company, so. But yeah, so you'd get people that come in and couldn't handle it and left, and then you'd have people who would, for the most part, stick it out for a career,
Wow.
and then
So
guys like.
So it was kind of a split. You'd see.
It was.
Okay.
It was a wide range, right?
Yeah.
It was tough to sink your teeth into for the most part. So you really had to be in it, and I guess you had to have a certain demeanor to not let it get to you, because for the most part, people did get kind of hot and bothered about certain aspects of the trading. But for the most part, I'd say you had a range of longevity in that business.
Okay, Greg, so I got a question for you. For a lot of people, they might not understand the reason why people even exist on the floor of the exchange
Sure.
anymore. Like, why not just have everything like the NASDAQ where it's all electronically traded at this point?
So it's interesting. I guess NASDAQ, I'm not sure when NASDAQ came into existence, but might have been either shortly before I got on the floor or while I was on the floor. And a lot of people questioned, how they're going to do that electronically and so on and so forth. I think there's two answers, right? One is having a human down there to monitor the situation outside of the trading gives it a little bit more connection to people who invest, retail, right? You send in an order, Merrill Lynch, Goldman Sachs, whoever you use, filters through their retail desk down to the floor. A Merrill Lynch broker gets the order. You're part of another thousands of shares of, say you're going to go buy an IBM, right? Someone comes in you come in with 100 shares. Someone comes in with 1,000. It gets all put together, person goes to the booth with 100,000 shares. They know they're not going to buy it over $100 or what have you, and they sit and they work it. So the machines can't really work the trade. The orders come in, they get paired up, and they're done, right? So you would literally have to break up orders into increments of different dollars, where a broker would come in and see what's going on and determine that they should jump in now, buy it all, maybe break it up over the course of the next half hour or hour, or step back. The stock's going, too high, not worth buying at this point, right?
So they have the ability to kind of personalize it more.
Exactly.
And they could look over at the booth and they see a big line of all sell orders, and they're like, okay, well, this isn't.
Yeah.
You know what I mean? Yeah.
Electronic order that's all it is, right? There's no control over that.
Yeah.
It's very automated, right? There's no artificial intelligence system that controls those orders that come in and monitor. It's very mechanical. So, and I don't know exactly all the inner workings of NASDAQ, but essentially that's what it is.
Yeah.
And so plus,
So would it be safe to say that if you were an investor that had a very large sum of money that was putting down on a particular stock, you would want that human interaction to be the interface to make sure that you're getting it at the price point, and maybe even take advantage of an opportunity if you saw an opportune time to even get it at a better price than what they had initially set.
Exactly.
So you're kind of getting that custom touch by going.
So it works. It works for the specialist firms, and it also works for big investors who have folks on the floor that can say, I'm buying 1,000 shares of IBM or more, but hey, look, AIG is going wild. Maybe I need my guy to go over there and buy something else, right?
Okay, Greg, I've been really looking forward to asking this question, because clearly working on Wall Street is a subculture.
Yes.
But hopefully you can give us a rare insight. Could you share the funniest story that you have experienced on Wall Street?
Yeah, sure. So the one that comes to mind, other than the one of me screaming at all the other brokers because it wasn't funny at the time, was I don't even know what was going on. It was a busy day. We had a couple of old timers on the American working with us. This was their whole life, and they were very, very rigid, jaded, structured, and set in motion. And we brought in some younger guys, younger than me at the time, because I was in my, I might have been 30, 31 when I was on the floor. I think somewhere around that age when I started. So we had a couple of younger guys, who were not as disaffected as today's generation, but didn't quite get the older guys, right? And I did, and I had a good rapport with them. So something was happening one day, and this young guy, I don't even remember his name, I remember his face, was the clerk for one of the older guys, who the two older guys stood next to each other, right? And something happened. He got mouthy with them, and it's something to do with trading. Should have done this, should have done that. I don't know what. So he called one of them. He didn't curse at him, but he called him something. I think the last guy's name was Matricelli, and he was a big, heavy guy, and he called him Mattress Belly. And so the dude, right? So the
Classy.
Mattress Belly, he basically tried to grab the kid. He took off, and our post was, like I said, like a deli counter. Well, the two of them are running around the counter on the middle of the trading floor, yelling at each other. Somebody had to intervene and to stop it.
And there you were.
Yeah, it was.
And there you were.
Like, I mean, where does that happen? Right in an office? It doesn't. Only
No
on the
way.
trading floor. Nobody thought too much of it.
Sounds like a cartoon.
It was pretty comical. And he obviously he never caught him. The guy was an older, heavy guy.
You had to go lay down on a mattress afterwards.
Yeah, it's pretty.
Oh,
funny.
yeah.
Yeah, that was probably one of the funnier things that happened.
Oh,
There was probably
geez.
many, but you were talking. I left the floor in the '90s, so I have distinct memories of certain things, but other stuff I've moved on kind of. So but that was pretty humorous.
Oh, nice. So, and people might not realize this, but Greg works for the government now, and he handles all the finances for a acquisition office. and he handles over $1 billion a year. So Gregg is quite accomplished. He's moved on to a lot of different things since working on Wall Street, where he had his own business. Now he's doing this, and so he's got a lot of really kind of neat stories. But so I'm going to go to the next one here. This is the one that Stig and I like to ask all the different people that come on the show. But what's the best investing advice that you have ever received, Gregg?
So I would have to say, and I wish I could remember this guy's name. He was on the New York Stock Exchange. He was one of our senior specialist brokers. Maybe it'll come to me. Italian guy. But this guy was a cool cucumber, man. He reminded me of Chaz Palminteri a little bit, but an older version of him. And he was always calm. And his thing was be patient. Just be patient. Whether it was trading for the firm, for Spear Leads, whether it was trading for himself, his demeanor was calm and cool and collected. And basically, that was just who he was. And that was, so be patient.
I love that.
Yeah.
I'm serious. I love that advice.
Yeah.
Just in your normal day life too. Like not even talking about investing. Like yeah. Great.
And that's how he was. I mean, you saw this. He was suave.
Yeah.
Well dressed. I mean,
I need to be more like that.
Tinted sunglasses on, right? Just like gradient sunglasses. So I think his name was Joe, and it was something Italian. I can't remember, but the guy was. I just remember him.
I love that.
Be patient.
Wow, that's really good advice.
Yeah, for anything, right? I mean, no matter what you're doing.
Yeah.
Before you make a decision, when you buy and hold something and watch it, so.
Yeah. Well, Gregg, let me ask this of you. We really like to discuss great books, and especially investment books. Do you have any books that influenced you, perhaps in particular, that you think our audience would appreciate?
Sure, and I'm going back to this guy again, Joe, right? So he used to carry this one large book around, right? Large hardcover book, a little torn and tattered. And he didn't talk a lot, but, I worked for him for a little while, or right next to him for a little while. And I asked him, what is that? No one ever even asked him, what that book is. I guess the other senior investors knew what it was. But it was, and I looked it up because I haven't thought about it for a while, except for a couple times in my current job. So it was called Japanese Candlestick Charting Techniques, and the author is Steve Nison, Nison, right? So I didn't know what it was at the time, and Joe shared it with me. And basically, what it was is it's a technical approach to pattern analysis and I looked this up, pretty much for any type of security, derivative, currency, what have you, right? Any type of traded thing. And so basically, they think it was first used in the 1800s in Japan by rice traders, right? They developed this technique. And I don't know all the history of it, but basically it was a pattern occurs over time the more data that you pull together. So one of the little excerpts from the book, and I went back and looked at this, was that if you had 10 candles in a row and you lit them all at the same time, they would burn differently, right? But then if you put another 10 next to that and another 10, a pattern would come out, right? So it's interesting because I didn't quite understand it back then. It was kind of philosophical, right? It was a little highbrow, and that's why this dude was, right? He was very, like I said, very cool, very interesting approach to things. And this was his kind of way he did stuff. But you can't use it alone in a vacuum. I think you have to combine it with other analytical tools. Yeah. Because it's not in itself, you need something to feed that to determine the pattern.
It's just so everyone in the audience knows. So everyone knows Stig and I are extremely hardcore Warren Buffett, long-term value investors that would buy a pick and hold it as long as we possibly can. And I think what Gregg is talking about here is something that could be beneficial to a person who, if you're listening to us and you're more of a short-term investor or something like that, the book might be a fantastic tool. And even if you're not, I think the book might be something that's interesting to consider just so you kind of understand that aspect of it.
Right.
You know, I'm of the opinion that the more vantage points that you understand about a particular area of interest, the more informed you are and the more intelligent you become, and you can make better and more informed decisions. So, you know, reading something like that and understanding the pattern analysis, and even if you were applying it to boom bust cycles, you know, if you were looking at, okay, what is the critical variable or some of the critical variables that causes the market to collapse? You know, I'm of the opinion that interest rates is probably one of the biggest critical variable for that to happen. Sure. So, you know, you could apply that, some of maybe the things that you'd learn in that book that Gregg's highlighting, to the pattern analysis of how interest rates work and how they interact with the market, you know. Very interesting.
Right. So you can marry up three things, or interest rates, earnings, you know, and then something particular to the industry.
Yep.
And then you'll probably see a pattern within the patterns, right?
Yep.
And if you layer them together. So I just found that really interesting. And, you know, it's a level of detail you could apply to short-term, long-term, and almost in anything where there's a consistent occurrence of something.
Okay, so Gregg, really appreciate everything that you've taught us and talked about. I mean, it's really interesting to be able to talk to somebody who's been there and done that on the floor of the New York Stock Exchange. So really appreciate that.
Pleasure.
At this point, Stig and I are going to go ahead and answer one of the questions that we had that came in on the website. And if anyone out there wants to send us a question and get it potentially answered on the show, go to asktheinvestors.com. And you can submit your question either by recording it and sending it to us, or you can type it up and send it to us. This one was typed up and sent. If you are going to record your question, try to make it as concise as possible and quick and to the point, because if it's too long, it's going to be hard for us to play it on the air. So with that said, I'm going to go ahead and read this question. It comes from Brandon Klein. And Brandon's question is, if we were planning to hold a stock forever, as Warren Buffett likes to say, and we've decided we can predict that the business will do well, say like 10 to 15% growth per year into the future, is it really that important to buy the stock at a discount to its intrinsic value? Because the stock price in IV will grow, or the intrinsic value will grow year by year. So Stig's going to go ahead and answer the question.
Well, first of all, Brandon, let me just say that it's a really great question you're asking here. And it also gives me the opportunity to reiterate that the most important attribute for a stock is really the quality of the business. I also think that was your point, Brandon. You probably know the famous quote by Warren Buffett, who was saying that he would much rather buy a wonderful business for a fair price than a fair company for a wonderful price. And I think that really pretty much captured this. But one thing I had to add here is that Warren Buffett, while he advocates that you should hold the stock forever, he actually rarely does that himself. And I'm not really saying that Warren Buffett is a hypocrite, not at all. But what he's actually saying is that you should have the mindset that you want to hold the stock forever. And the major reason for that is that you'll have to pay capital gains tax whenever you're selling the stock. So that's definitely an important aspect to think about. But let me give you an example of what it is that Warren Buffett is talking about when he's speaking about buying a stock at a discount to the intrinsic value. For instance, let's say that you buy a stock at a fair price and you expect it to get a 10% annual return. By a fair price, again, that is related to the quote, that is equivalent to the intrinsic value. So you're saying the price of the stock is $10, and that is also the value of the stock. And say that you want to hold that stock for 10 years. But if you bought that stock at a 50% discount to the intrinsic value, you would get close to 18% annual return instead of the 10% over that time period. And really 18% compared to 10% over the long run, that's really means the world.
Hey, I've got something I want to piggyback onto what Stig said, because he's exactly right. So if you can buy it, let's say you think it's worth $10 and you can get a 10% return using a discount rate that would give you that $10 price point. If you can go ahead and buy it at $5, okay, you're able to increase that return significantly, okay? And what you're doing when you do that, it's almost like you're able to warp yourself back in time. It's almost like you could say, if I would buy Berkshire Hathaway right now, I know that it's trading for like $135, $140 right now. But if I can buy that at $100, that's almost like I went back 3-4 years ago and was able to buy the stock at that point in time. And so then you're able to basically get more compound interest out of it. So that's just a different way to look at it. But I mean, if you can buy something for a 10% yield, that's fantastic, or expected 10% yield. But if you can buy it at even cheaper price, you'll even get a higher yield. So that's, I guess, the best way we can answer your question, Brandon. And we really appreciate you typing that up and sending it to us. So we're going to send you a free signed copy of the Warren Buffett accounting book. And we just really hope to have more questions like that in the future and to be able to interact with the audience. So that concludes our show for today. Again, we want to say thanks to Gregg Pisani for joining us, and we hope to see you next week with our next episode. So thanks for joining us.
Thanks for listening to The Investors Podcast. To listen to more shows or access to the tools discussed on the show, be sure to visit www.theinvestorspodcast.com. Submit your questions or request a guest appearance to The Investors Podcast by going to www.asktheinvestors.com. If your question is answered during the show, you will receive a free autographed copy of the Warren Buffett accounting book. This podcast is for entertainment purposes only. This material is copyrighted by the TIP Network and must have written approval before commercial application.